So naturally with a loan there is risk in that you have to pay back the interest and eventually the principal. So demonstrating your sales forecast is a true reflection of what you will achieve is key, as well as some of the operational elements. Demonstrating that your revenue is not too concentrated on one particular customer is something that they analyse in detail. So those are the kinds of things that you should articulate as part of an application. I've seen a lot of experienced CFOs as well as CEOs when I'm guiding them through the application process make a couple of errors when it comes to loan applications specifically, because it's its own beast. So the forecasts for the financial statements for your company have to cover the entirety of the loan term, so that's number one, and there has to be a lot of justification for the metrics being presented, more so than a typical board meeting that they may have with their shareholders. So that's probably the biggest one. Not understanding the covenants and the seniority of the debt, and that for Innovate UK loans in particular, they can't take a lot of the IP as collateral because that's not what they're interested in. So they'll take a fixed and floating charge across some of the other assets. And the last one is that if you're looking to raise equity in order to help pay off the debt, that can sometimes be a barrier. So what you want to demonstrate is that you're either raising equity separate to the debt raise, or you've raised it and that will help go pay for the debt raise. So innovation loans are assessing you on two things. There will be a technical criteria. Is this project that they're looking to fund innovative enough and within the key sector strategies, so clean technology, AI, etc. Then there will also be a financial assessment. Is the business healthy enough? Is there solvency? Do they have the capacity to take on that debt? And what is their capital structure? Are they over leveraged, for example? So those are the reasons that they will assess you on in a simplistic way, red, amber, green structure. And a good credit assessor will guide you through the process if you have the hallmarks of being successful, but they want to clarify a few things. And because the process can take quite a long time, some of the projections that you've presented may be out of date, and they'll want you to revise them. That's a really important question. So value for money from Innovate UK's perspective means a couple of things. That the project is worth doing and that it's going to generate a return for the UK economy as well as the taxpayers. This could be tangible, so we will create more jobs, we will make products cheaper, or it could be slightly intangible, we will make people happier, or they will have greater access to new products and services. There's also a need to quantify economically the value of the subsidy, because this is essentially a subsidised loan. So if your project is worth £1 million, could you have delivered the same output for slightly less money? So those are the things that they're looking for when it comes to value for money.